you don't like to make rate projections. You do have a model roughly in your head where you say in the memo that you don't think that rates are high. They're kind of
No,
more
they're not
normal.
high
Right.
relative to my experience.
So if that's the case, you kind of game out a 3 to 3.5%
Yes.
Fed funds rate
Yes.
over the next 5 to 10 years. What then does that mean for returns just more generally? Does that mean that they're better in credit and better in your world? Or are they kind of worse because the overhang that we've had of the easy money policies is going to take a lot to work through?
Well, it's a complex question. But those, we're at 5.25 to 5.5 on the Fed funds rate now. That's a measure determined to crimp the economy to kill off the excess inflation. The target is 2, we're above 2, cool off the economy until it moves toward 2. By the way, in Powell's remarks on Monday, he said, we won't cut rates until we see we're making progress toward 2%. I thought that the word toward was very important. He didn't say until we're at 2%. So I think that, if inflation starts going, 3, 2.75, 2.5, maybe he'll start cutting. I don't know. But the word toward was important. The only thing I'm sure of is that if interest rates are higher, the people who invest in credit instruments, which is what we do, are buying in at higher yields and invariably will have higher returns than they have in the recent past. So today's rates are not high historically, but they're certainly higher than we had from 2009 through 21, which means the returns on credit investing, fixed income investing, bond investing, loan investing, will be higher than those in that period, which were, really paltry.